Hi students, and welcome to SolutionInn YouTube channel. Today's video will be longer than our previous videos because we will cover consolidated statement of financial position in detail. Why the consolidated financial statements are prepared and how the consolidated statement of financial position is prepared. We will also cover the details of each step of consolidated statement of financial position, that will include goodwill and calculation for non-controlling interest. First, we need to understand the nature of a group and consolidated accounts. A group consists of a parent entity and one or more subsidiary entities. An entity is a subsidiary of another entity if it is controlled by that other entity. By control, we usually mean that more than 50% of its equity shares are owned by that other entity, the parent. Within a group, company C might be a subsidiary of company B, which is a subsidiary of company A. In that case, company C is a sub-subsidiary of company A. Group structures with sub-subsidiaries are called complex groups. That will be covered in some other video, but we will discuss the basic group structure and consolidated statement of financial position if the group structure is not complex. So the entity that ultimately controls all the entities in a group is called the parent. A parent is defined as an entity that has one or more subsidiaries as per standard IAS 27. Now come to the definition of control in detail. Control is assumed to exist when the parent owns directly or indirectly through other subsidiaries more than half of the voting power of the subsidiary, unless in exceptional circumstances it can be clearly demonstrated that such control doesn't exist. Control also exists when the entity parent owns half or less than half of the voting power of the entity, but any of the following circumstances also applies. The entity has power over more than half of the voting rights in the subsidiary by virtue of an agreement with other investors. The entity has power to govern the financial and operating policies of the subsidiary entity under a statute or agreement. The entity has power to appoint or remove a majority of the members of the board of directors of the subsidiary, and the board of directors has control over the entity. So, what is the purpose and nature of consolidated financial statements, and why we need to prepare consolidated financial statements? When a large part of assets of a parent consist of investments in subsidiaries, it is difficult for the users of the financial statements of the parent to understand anything about its financial position or financial performance. If the parent company only reported to its shareholders about the financial performance and position of the parent itself, the statement of financial information might contain little more than investments in subsidiaries at cost, and the profit for the year might consist a little more than dividends received from the investments. To find out meaningful information about their investment, users of the parent's financial statements need to know about the financial position and performance of the operating subsidiaries in the entire group of companies. The purpose of consolidated financial statements is to provide financial statements that have meaning and relevance to the users. When a parent acquires a subsidiary, both the parent and the subsidiary remain legally separate entities. However, in practice, they operate as if they were one organization. So that is why consolidated group financial statements are prepared, because the group is acting as a whole single entity. So consolidated financial statements reflect the reality of the situation. The group is a single economic unit. In preparing consolidated financial statements, especially profit and loss and the balance sheet, the profit of the parent and its subsidiary and their other comprehensive income are combined into a single and consolidated statement of comprehensive income. We will discuss statement of comprehensive income in a separate video, but as far as the consolidated statement of financial position is concerned, we will discuss that in detail. While preparing the balance sheet, the assets and liabilities of the parent and its subsidiaries are combined in a single consolidated statement of financial position. However, the share capital and reserves of the consolidated balance sheet are not calculated simply by adding the capital and reserves of all the company in the group. We will discuss that part in detail when the time comes. So, what is the requirement of the international accounting standards regarding the preparation of consolidated accounts? As per International Accounting Standard 27, it states that with certain exceptions, a parent company must present consolidated financial statements in which it consolidates its investments in subsidiaries. In other words, a parent must prepare consolidated financial statements for the group. Exceptions to these rules are that a parent need not to prepare consolidated financial statements if and only if all of the following conditions apply. The parent itself, for example, a parent X is a wholly owned subsidiary with its own parent Y. Alternatively, the parent X is a partially owned subsidiary with its own parent Y, and the other owners of X are prepared to allow it to avoid preparing consolidated financial statements. The parent debt or equity instruments are not traded in public market. So that makes a parent company a non-public entity. The parent does not file any financial statements with the security commissions for the purpose of issuing financial instruments in the public market. So that is one exception in which the parent doesn't have to prepare consolidated financial statements. So let's discuss how the consolidated financial statements are prepared. Typically discussing the consolidated balance sheet or consolidated statement of financial position. The basic rule is that a consolidated statement of financial position brings together the assets and liabilities of the parent company and all its subsidiaries. Some adjustments are made to the assets and liabilities for the purpose of consolidation, but the assets of the group minus its liabilities are the group's equity. The basic rules for preparing consolidated statement of financial position can be illustrated with a simple example. In this example, the parent owns 100% of the equity of the subsidiary. The parent acquired its investment in the subsidiary when the subsidiary was first established. For example, it was the first day of its operation and the parent acquired on that particular day. So this means that the acquisition date, as of acquisition date, was the first day of its operation. The subsidiary will have no pre-acquisition profits. So the cost of investment in the subsidiary is exactly equal to the fair value of the net assets in the subsidiary as at the date of acquisition. When all these conditions apply, a consolidated statement of financial position can be prepared as at the acquisition date of the subsidiary by simply adding the assets of the parent and the assets of subsidiary line by line. However, excluding the item investment in subsidiary that is appearing in the financial position of the parent company. Now, if we have added the assets of parent and assets of subsidiary but not included the investment in subsidiary portion, now comes to the liabilities. We will add the liabilities of parent and liabilities of subsidiary line by line. We have total consolidated liabilities. Next come to the equity. The equity and reserves in the consolidated statement of financial position consist of the equity and reserves of the parent and only the reserves of the subsidiary that have been earned since its acquisition. As at date of acquisition, these were 0, as we discussed that this was the first on the first day of the subsidiary's incorporation it was acquired. So there were no previously before date of acquisition equity reserves. So let's do a simple example that will explain the basic structure of how the consolidated statement of financial statement looks like. All right. A parent entity P acquired 100% of the equity shares of a subsidiary entity S when the subsidiary was first established. Now this is the same case as we discussed above, that subsidiary has no pre-acquisition reserves. Now the net assets of S, net asset means that assets minus liabilities equals equity. The net asset of S when it was first set up, total assets minus total liabilities were valued at $120,000 and P paid $120,000 to acquire these net assets. Now this is the same condition that the cost of investment is equal to the net assets of the subsidiaries acquired. So this is the most simplest case that we can learn the basic steps of consolidation from. So no additional payment was made means no purchase goodwill. We will cover the goodwill in a later part of this video. Okay, now here is the consolidated statement of financial position. Now recall the first and second rule. We will add the assets and liabilities of both parent and subsidiary line by line. Note that we have not written the investment in subsidiary that was showing on the parent's balance sheet. This will leave us to account for the group equity. Now we have accounted for the assets and liabilities. Now we are going to have a look on the group equity. Okay, remember the rule 3. We will add up the reserves of the parent and subsidiary, but only take the share capital and share premium of parent. In this example, the subsidiary had no pre-acquisition reserves. So that is why the total retained earnings are same as before for the parent. Subsidiaries are often acquired after they have been incorporated or established. In this example, the subsidiary was acquired on the very first day of its incorporation, but there can be cases when subsidiary have established and have taken some time to run operations, and then it is acquired by another parent. So in that case, the acquired subsidiary will have some accumulated profits, in other words retained earnings, at the date of acquisition. These are called pre-acquisition profits or pre-acquisition reserves. Pre-acquisition profits of the subsidiary are not included as retained earnings in the consolidated financial statements. Why? We will discuss that while we will be calculating the goodwill. They are dealt with as part of the purchase goodwill calculations, so we will discuss that in the later part of this video. So however, post-acquisition profits of the subsidiary are included in group profits in the consolidated statement of comprehensive income as a part of the profits of the entire group. They are also included in the retained earnings of the group, and so are included in the consolidated statement of financial position. As of now, we are preparing consolidated statement of financial position only, so we will take a deep understanding how they are going to be part of the consolidated retained earnings. To understand it, let's do an example. A parent P acquired 100% of the share capital of subsidiary S on 1st January of year 3. The net assets of S, that means total assets minus total liabilities, were valued at $200,000 at the date of acquisition, and P paid $200,000 to acquire the shares in S. Now this makes the example much simpler because there is no goodwill once again, because the cost of investment is exactly equal to the value of the net assets. The summary statements of financial position for both entities at 1st January year 3 and at 31st December year 3 are as follows. During the year to 31st December year 3, entity P made a profit after tax of 90,000 and the entity S made a profit after tax of 60,000. Now this information is usually not given in the basic separate financial positions of parent and subsidiary, so you will be seeing a different note at the bottom of this information. Neither entity paid the dividends, so this makes our retained earnings calculations more simpler, that there will be no deductions of dividend from the group or subsidiary retained earnings. Now this is additional information to our previous example. The consolidated profit of the year is 90,000 for the parent side and 60,000 from subsidiary side. That makes the total profit of $150,000. Because all the profits of S are post-acquisition profits, subsidiary was acquired on 1st January. This makes the whole profit to be accounted for as part of group retained earnings. The consolidated statement of financial position at the date of acquisition of subsidiary at 1st January year 3 is as follows. First, we will add the assets of both parent P and subsidiary S. We have property, plant and equipment for parent 670,000 and for subsidiary 170,000. So this will make total of 840,000. Then we have current assets. For parent these are 110,000 and for subsidiary these are 80,000. So this will make 190,000. So when we add up the total assets, $840,000 plus $190,000, the total assets of the consolidated balance sheet will be $1,030,000. Note, we have not written the investment in subsidiary as part of the asset side of the parent company because in consolidated statement of financial position this is not written. We will know why, because this part is the part of individual financial statement, and for the group purposes the consolidated figures are added and individual figures are not. Alright, let's move on to the equity and liability side. At the date of acquisition we have the share capital and share premium of parent only. That's rule number 3. Retained earnings of parent will be taken in this example as part of the question. So the total equity will be 810,000. Note that none of the pre-acquisition retained earnings of subsidiary are included in the consolidated statement of financial position because technically they are incorporated as part of the goodwill calculation. We will take that in a moment. Now we will add the liabilities of the both parent and subsidiaries. They will add up to make $220,000. This was consolidation as at date of acquisition. Now the consolidated statement of financial position that will be required to be prepared on the closing of the year, I mean end of the year, that is 31st December year 3 or the reporting date. This will be as follows. First we will add the group assets without the investment in subsidiary appearing on the parent's balance sheet. This will make non-current assets of $680,000 plus $245,000 totaling $925,000, and current assets will be $175,000 plus $90,000 totaling $265,000. The total assets will then be made as $1,190,000. Now come to the equity side. We will take the share capital of and share premium of parent only, but consolidated retained earnings of the group include both the profits of the parent and the post acquisition profit of the subsidiary as. Now that this is the difference of calculation at the date of acquisition and at the reporting date. At the date of acquisition we will disregard the post acquisition profits of subsidiary because we haven't passed through a year. So, and once the year has passed, then the reporting date has reached. Now we have a right to incorporate the profits, post acquisition profits of subsidiary to the group consolidated retained earnings. So this is the basic difference between how to account for the pre-acquisition reserves and post-acquisition reserves. Right? The post-acquisition profits of S and is the profit in the whole of year 3 was, as given in the other information, was 60,000 since it was acquired on 1st January. So this will make the total equity equaling $960,000. Now we will combine the liabilities to form total of $230,000, and the consolidated statement of financial position is complete. So far we have covered the basic structure. If the subsidiary is wholly owned 100% owned by the parent and with no complex structures, we have discussed two scenarios, in which first one is that we have covered that the subsidiary was acquired on the first day, and then we have covered if the subsidiary was acquired after some time of its established. So let's go to our next concept of goodwill. When a parent company acquires a subsidiary company, the price it pays is normally more than the fair value of the net assets of the subsidiary, because normally when you are going to buy something by a business, you will have to pay something extra. That is why the seller will be agreeing to sell you your business. So this is because the market value of the company is normally more than the value of its net assets. The difference between the fair value of the purchase price paid and the fair value of net assets acquired is purchase goodwill, usually called simply goodwill. So to understand this, let's see this illustration. Cost of acquisition is A, fair value of net assets acquired is B, then goodwill will simply be A minus B, the additional amount that we have paid for acquiring net assets of subsidiary. So purchase goodwill is included in the consolidated statement of financial position, and as an intangible asset, this will be shown on the face of consolidated financial statement. In this respect, purchase goodwill differs from internally generated goodwill, which is not included in the financial statements. An important point to note is that the initial cost of goodwill is measured at the date of acquisition of the subsidiary. So when we calculate the goodwill, we will have to first find the net assets at the date of acquisition. So we will be in position to compare it with the cost of investment that we are going to pay to the subsidiary to acquire these net assets. So the purchase goodwill is the difference between the cost of acquisition of the subsidiary and the fair value of net assets acquired. It was stated in the previous section that in any acquisition there will be some cost directly related to the acquisition. This is something that usually is defined by the International Financial Reporting Standard 3 that was revised from 2008. It was the accepted practice to include these directly related costs in the cost of acquisition. This meant that the costs were included in the calculation of purchase goodwill. With the revision of IFRS 3, this is no longer permitted. Costs directly related to acquisition should not be included in the cost of acquisition, and it should not be seen as a part of the cost of investment. Instead, they are treated as an expense and written off against retained profits in full in the year of acquisition. Purchase goodwill therefore excludes these directly attributable costs of acquisition. Let's do an example to understand this. A parent P acquired 100% of the share capital of entity S, a subsidiary, on 1st January of year 3. Now parent paid $230,000 to acquire the shares in S, subsidiary. The summary statements of financial position for both companies at 31st December year 3 are as follows. Now you can see that the basic information is given in this, but the additional information is as much important as these figures are. So we have some additional information. At the date of acquisition, the fair value of the net assets of subsidiary S were 170,000 and expenses directly related to the acquisition were 75,000, but these have not been included in the figures above of parent, as you can see. Now in this example we will calculate the goodwill and see how it will affect the consolidated statement of financial position. For goodwill, just to remind you, the formula is goodwill is equal to cost of investment minus fair value of net assets of subsidiary at date of acquisition. This is very important to note, at date of acquisition, and as important is that goodwill will be calculated exactly at the date of acquisition, because we are comparing what we are acquiring against the cost we are paying to subsidiaries investors. So let's find out the net assets of subsidiary at the date of acquisition. The formula is simple. Net asset means equity that will include share capital plus share premium and any pre-acquisition reserves. In this example, we don't have any pre-acquisition reserves, or if we have one, we can assume that 100,000. So we will take share capital and share premium of 50,000 and 20,000 share premium and 100,000 of reserves. That will make total net assets, equity, equal 170,000. So the goodwill will be 230,000, that is the cost of investment we paid, minus 170,000, that is the fair value of net asset that we acquired. So the goodwill will be 230,000 minus 170,000 equaling $60,000. Let's see how this will appear on the consolidated statement of financial position. First we will write down the assets and then we will have goodwill. See above the working that we have. So the goodwill is $60,000. Then we have other assets, 570,000 for parent and 240,000 for subsidiary. Less, and we are deducting the 75,000 of the expenses because this is not part of the cost of investment, so we are deducting it from here. 75,000 minus this will make our other assets total of 735,000. So adding up 60,000 and 735,000, this will make our total assets 795,000. Now the equity side. Equity share will be shown for the parent only, that will be $200,000. Share premium for parent only, that will be shown as $100,000. Now the retained earnings. Since we have acquired the company at 1st January and now we have crossed all the full year and we have to incorporate the post acquisition profits of the subsidiary, so retained earnings will be the balance of parent retained earning, that is 440,000, plus any post acquisition profits from the subsidiary, that are $25,000 in example, and we will deduct the directly attributable costs of acquisition, that were $75,000. So this will make our retained earnings, consolidated retained earnings of $390,000. So adding up these, we will have a total equity of $690,000. Now the easy part is that we will add up the liabilities for both parent 60,000 and for subsidiary 40,000. So this will make $105,000. So the total equity and liabilities will be $795,000. So this is how to incorporate goodwill in and in the consolidated statement of financial position. Up till now, we have covered consolidated statement of financial position with a wholly owned subsidiary. Let's see what happens if the subsidiary is acquired partially. When a parent entity acquires less than 100% of the equity share in a subsidiary, the remainder of the shares in the subsidiary are held by other shareholders. These are called the non-controlling interest or minority interest in the subsidiary. The abbreviation NCI is used for non-controlling interest commonly. Let's take an example. For example, P might acquire 60% of the shares in S. It has acquired 60% of the equity ownership. That means it has acquired the control over subsidiary. The remaining 40% of the equity in subsidiary is owned by the non-controlling interest. Simple. Non-controlling interest is defined by IAS 27 as the equity in a subsidiary not attributable to a parent. It means that part of equity that is not controlled or attributable to the parent is the NCI. So how do we account for non-controlling interest? The consolidated statement of financial position must present the assets, liabilities and equity of the group as a whole, including the non-controlling interest. Now, the part of the non-controlling interest being part of the equity, it should separately shown in a separate head under equity. However, it must be shown separately from other attributable equity components such as different types of reserves. So, this presentation reflects the fact that although the parent does not actually own 100% of the assets and liabilities of the group, it controls 100% of these assets and liabilities. When a parent company acquires less than 100% of subsidiary, there is presumably some goodwill in the subsidiary that is attributable to the non-controlling interests. The IFRS 3 allows two methods for calculating non-controlling interest goodwill: fair value method and proportionate shares of assets method. When proportionate method is used, the non-controlling interest will have no share in goodwill and NCI should be valued at proportionate share of the net identifiable assets of subsidiary. For example, if the non-controlling interest in subsidiary is 30% and the identifiable net assets of the subsidiaries are 1 million, the non-controlling interest should be included in the consolidated statement of financial position at simply 1 million times 30%, that will give us 300,000. When the fair value method is used, we will recognize the goodwill attributable to the non-controlling interest in the consolidated statement of financial position as the date of acquisition. Again, this is a reminder that goodwill is calculated at the date of acquisition. So, this goodwill cannot subsequently be revalued unless there is an impairment, and the goodwill should then be written down in value. Alright, so let's learn how to calculate the non-controlling interest with an example, and that will be our last main component of this video. So step 1, to calculate the non-controlling interest, we have to identify the group share and non-controlling interest share. In the given example, as we can see, there are total 500,000 shares in the subsidiary, and the parent owns 400,000 of them. This makes parent share of 400 divided 500 equaling 80%, leaving the non-controlling interest with 20%. Now second step, we have to calculate the subsidiaries net assets at date of acquisition and at reporting date. The net assets at date of acquisition at fair value are equity shares of 500,000, share premium of 100,000, revaluation reserve of 100,000, retained earnings of 300,000. This will give us total net assets of subsidiary at date of acquisition of $1 million. Now, to calculate the goodwill, the calculation of goodwill must allow for the fact that the parent has acquired 80% of the fair value of the net assets of the subsidiary. So fair value of the net assets acquired will be compared to the percentage of parent share in the net assets. Although the whole of the net assets are now controlled by the parent, we have to assume the group share only. So the cost of acquisition is 950,000 that we have paid, and the parent has acquired 80% of the net assets. That makes 1 million times 80%, that's $800,000. So our goodwill will be $150,000. Now this part was easy. Let's see how the net non-controlling interest will be calculated, since we have assumed that we are using the fair value method to estimate the non-controlling interest. So calculating the non-controlling interest when the non-controlling interest is valued at proportionate share, this was very easy. In this case there will be no goodwill that will be attributed to NCI. So non-controlling interest owns 20% of the net assets at the date of acquisition. Non-controlling interest is equal to $1 million times 20%, that makes 200,000. The consolidated statement of financial position as at the date of acquisition is prepared as follows. Note that the non-controlling interest should be shown as a part of equity, but separate from the parent's share. So as of now we have covered the basic structure of the consolidated statement of financial position. We have done some practice with simple cases of wholly owned and partially owned subsidiaries, and learned how to calculate the goodwill and how to calculate non-controlling interest. If you guys have any questions, you can put that in the comments and we will try to respond as quickly as we can. Hope you have a basic understanding of consolidated statement of financial position by now. So thanks for watching. Take care. Bye bye.